We're getting close to the number crunching. To know some of you are like, can we do some number crunching? So started a whole new topic on workers' comp insurance. We are getting a little ahead in this class, so we give us some time to maybe do some DFA at the end. This is a really cool topic, and I want to at least let you know and be aware of it. It's a pretty interesting topic. So we'll see. Workers' comp is not something I have a lot of experience with. Oh, I pushed the button, but I don't know how many times I have to push it. All right, well, we'll wait for that to come up. I used to do a presentation when I was at UTSA. I did a presentation on DFA, which is dynamic financial analysis. And we just went all over the country, and there was 3 of us. I did DFA, and then one of the other presenters is a lady from, I can't remember, somewhere up north. And she was a workers' comp person. So the 2 of us were always in this panel together. So I had some exposure with workers' comp doing that. And then I changed my career. I was in finance and the investment side, and I took a job in risk management and workers' comp. So I was doing workers' comp every day. And then a week later, my boss decided to leave. So I went back and took his job. So I did workers' comp for 1 week. That's my entire practical experience with workers' comp. I did learn a lot in that 1 week. It was really pretty amazing. USAA has a lot of employees, and so it was a big deal for them. Workers' comp, a lot like auto and homeowners, every state has their own thing. And it's been in the news. It was heavily in the news at the same time all that tort reform was going on. Workers' comp was starting to blow up. It was getting really expensive. So every state has a little bit different history, a little bit different issues. But to give you the general history of workers' comp, it really is something that follows pretty closely with just U.S. history. It's not that the workplace got more dangerous. It's that the workplace changed. So we went from agriculture to industrial. The farm was a dangerous place to work. People got injured all the time, got hurt all the time, but no one cared because it was family and there was no regs. You just broke, you broke your leg and your dad said, walk it off. It was just the nature of the business. We didn't think about suing our own families or whatever. And it was, so we've gone from that to heavily industrial, and then we went from industrial to office. So the world's been changing from that standpoint. But what was happening wasn't that people were getting injured more often, but now it was someone you could sue versus your family. So that changed. But early on, employees get injured on the job, and their bosses would take care of them less than they would take care of a customer or a non-employee. So employees had less rights that were inferior to someone who didn't work for the company. And there's a couple of reasons. First, the employer could say, hey, if you sue us, we're gonna fire you. So they had that risk. They could say it's your fault and cause your negligence, which a lot of times that was true, right? You got a lot of workers, industrial age, people coming from the farm, dealing with heavy equipment they've never seen before. They may not be well trained, but the boss still says you weren't well trained, but it's still your fault. You weren't careful. You need other employees to back you up, and they don't want to testify because they're worried about retaliation. So it was just difficult for workers to actually get their day in court. And then the employer could actually argue 2 things. They could argue, hey, it wasn't our fault, it was these other workers' fault. They were negligent. And the whole argument of they weren't well trained wasn't a strong argument, in fact, then. And then the other thing to do, which is really our true thing, is they could say the assumption of risk, and that is When we talk about liability, that can be a defense. If you know you're doing something dangerous, you end up getting hurt, and the other person was negligent, but you knew it was dangerous, that can be a defense, that you assumed the risk, you knew what you were doing. Like if you've been joking about how horrible your friend is as a driver, but you keep riding with him, and then he has an accident, he could say, hey, he knew how bad of a driver was. He jokes about it all the time. He didn't have to get in my car. So that's what employees are arguing. You want to work in the coal mines? Coal mines are dangerous. You know it's dangerous. We're paying you more money because it's dangerous. That just comes with the job. Get over it. You know, that kind of argument. It doesn't sound good in today's terms, but back then that kind of argument would work. And there is a book, it's a book by the guy who wrote 1984 on Animal Farm, but I always get him mixed up. What is his name? Who wrote Animal Farm? Orwell. Yeah, I always get the Orwell guy mixed up with the guy who wrote War of the Planets. But anyway, he wrote a really good book. Boy, just so fascinating. I cannot remember the name of it. I'll have to look it up one of these days. But he goes in detail about coal mines in Europe, especially in the UK. Really horrible life these people went through. Really, but when the industrial age started, employers felt no obligation to make the workplace safe. It was pretty horrendous. So obviously Orwell was somewhat, socialistic, anti-capitalist, so he probably exaggerated maybe somewhat in it. But he was he was telling real life stories from people. So we went from this age where the employee said, hey, it's your problem, you figure it out, we're not responsible for it. And then all of a sudden, employers started, especially I think Teddy Roosevelt and a lot of regulations that came in the early 20th century, the end of child labor and all these kind of things, the sea kind of changed, and employers started having their defenses chipped away, courts started getting more favorable, there was a lot of new regs coming in, and suddenly governments were saying, employer, you're required to provide a safe working area and to warn of unsafe conditions. You can't just say, hey, workers, here's the work environment, go figure it out. You're responsible to step in and make it safer. Well, now the problem is employees were suing too much. And so now US employers are saying, hey, we can't compete with Europe and Asia if our employees are going to be suing us every single day. So we need some protection. And the US, tends to sue more than other countries. And so workers' comp then started to show up. It started in 1911, which is, I think, pretty close to Teddy Roosevelt's years. So he went out in 1909. So it kind of makes sense. Workers' comp is at the state level. So Teddy Roosevelt was at the federal level. But that's when you're starting to see a lot of these regs coming in. And so it's starting to pass down through the state. So Wisconsin's the first state to pass these laws. Mississippi's the last state in 1948. So there's a pretty lengthy 30 years span there between the start and to the end. And so what do these laws do? So what these laws said was, okay, workers, you need to be protected, but all these lawsuits is just tying up too much time. The only one really winning in all this is the lawyers. So we don't want you suing. Employers, you're going to have to take responsibility for this. You're going to have to make the workplace safe, but we agree you shouldn't be sued. So we're going to essentially take something that doesn't apply to the work environment, but we're going to make it apply, and that's strict liability. So strict liability says, employers, you're liable even if you weren't negligent. And that's what strict liability is. Normally, strict liability applies when you're doing something really dangerous and just by its nature, like you're blasting dynamite, you're delivering pianos, grand pianos. You're doing something that just by its nature just seems really dangerous. So we don't care if you're negligent or not, we're just going to assume you are. And so that's what they apply to the worker. The employer is assumed to be at fault, even if they weren't negligent. Which the wonderful thing for the worker is they don't have to prove negligence. In the past, they had to prove that the employer was actually negligent. Now they don't. All they have to do now is prove that they were injured on the job. They can prove they were injured on the job. There is no more discovery. They have a claim. The employer has to pay. So the employee then, and this is the part I think is probably the most confusing, because if you drive down I-10, you'll probably see some workers' comp billboards from trial lawyers saying, if you have workers' claim, come to us, we'll help you. And yet workers' comp, the intent is that the employee doesn't sue. Well, obviously, employees are suing, so there is something still going on here, but it greatly reduced those lawsuits. Most people are not going to sue. The employer is just going to pay. So the employee says, we're not going to sue. They give us that right. They also give us the right to general damages, pain and suffering. And the benefits are scheduled. So if you have back injury, or if you lose a limb, or lose one of your senses or whatever, this is what you're going to get paid. So it's scheduled by the states. And that's the other reason why this is so difficult to talk about, because every state is going to have their own schedule. It's heavily regulated by the state governments. There's workers' comp is regulated. It is somewhat coordinated by the NAIC. So the regulators do get together to try to make the states as similar as possible, but workers' comp tends to have its own life. So there has been some debate recently. We're going to get into some of this debate recently, but what if you work for Canon? Canon makes copiers. So you work for Canon, and one of your jobs is to make copies, and the Canon copier you're using blows up on you. Is that workers' comp, or is that product liability? You probably want to be product liability. Why? Because you want some pain and suffering. You might even want punitive damages. If it's under workers' comp, all you're going to get are those scheduled benefits. So you'd like to be able to sue them under the product liability, and states are more and more allowing employees to do kind of get outside of the workers' comp and sue their employee. So there has been some crumbling of this pure strict liability, especially the employee's right to sue has been changing. So in the 80s, workers' comp was starting to blow up. A lot of it had to do with the healthcare aspect of workers' comp. So health, I hate the fact that healthcare is all over the place. You buy healthcare, you have it in your auto insurance, you have it in workers' comp. So all these different groups, I mean, if you call in with a health insurance claim, probably the first thing they're going to ask you was, were you working when it happened? Because your health insurance company wants to shift it over to the workers' comp people, right? So they ask that. If you were working, they're going to say, hey, it's not our problem. What's the second question they ask? Where are you driving? And then they're going to ask, do you have Part B, or Part C of your auto insurance, right? So they don't want to pay the claim. So you have all these different areas. So workers' comp is just another area of workers getting health insurance. And it got caught up in the inflation of healthcare during the 80s. And so workers' comp started blowing up. So let's talk about workers' comp, the way it actually works here. It's about 1.6% of employer spending, so it's not an immaterial part of employee compensation. And it does vary dramatically depending on what industry you're in. Obviously, the insurance company is going to charge more for someone that's doing coal mining than someone that's a desk job, an accountant sitting behind a desk. When's the last time you saw an accountant seriously injured on the job? Doesn't happen very frequently, right? You probably know someone. I can't think of anyone. School teachers, I did the workers' comp for, we did the insurance for a small private school, and our biggest claim was a teacher tripping and falling at work, and that was a massive, massive claim. It was pretty expensive. So, they're walking around, they have kids, so they're much more active. So it can depend on the industry that you are in. The way it's actually defined is who's covered and what's covered. So who's covered is essentially all your employees unless they're excluded. So most employments, if you walk in, you'll find, have y'all seen the workers' comp sign? Are you familiar with that? So the last time I saw it, it had the wrong side up. It says, do not show this side, and they had that up. It was supposed to turn it over for the employees. So they're still on their own side of it. But all the rules, when are you covered, who's not covered, who is covered, what are you covered for? So state law requires you to put that up. There are some things that are not covered: domestic service, casual work, agricultural, and then there is a limit for how small a business is and be covered. Very small businesses. There's some places where you don't do business unless you're sure they have workers' comp. So if you're dealing with subcontractors and you're a construction firm, well, you better make sure you have workers' comp because people get injured, hard hat areas all the time. So most of y'all are going to be automatically covered in your job: finance, actuarial science, right? You're going to be covered for workers' comp. What injuries are you most worried about? So I started my career in the 80s, and there was a particular, see if I can guess this one, there's a particular injury that just suddenly started cropping up that no one had ever heard of before. And employers started off saying, oh, those crybabies, what are they complaining about? What do you think that was? Any guesses? Carpal tunnel, yeah. People started coming and saying, man, my arms are just, and employers like, just stretch. What's your problem? You're just typing wrong. You're not sitting right. Like, we don't care. And then suddenly it became 90 something, at USAA was 90 something % of the workers' comp claims were carpal tunnel. There were people in long-term disability with carpal tunnel. They could not work in any job for 30, 40, 50 years. They retired with carpal tunnel. Some court reporters were getting that. So suddenly that USAA became a big deal, and then it became irritating because then they went around every desk and set up your desk just for you, which is really irritating because if I went to someone else's desk to do something, it was either way up here or way too low, and so you couldn't switch desk anymore. So they really addressed it. I haven't heard carpal tunnel in a while. I don't know why it's somewhat going away, but it was a huge, huge deal there for a while. So this does make an interesting paper for paper two, because of what happened with COVID. So we'll talk some about that. But there are people that are not covered, so you can't assume that you're covered. So what does it cover? So this is probably the most important part of all, is this statement of what's covered. It's accidents arising out of and in the course of employment. That's probably where the lawyers are doing their lawsuits. Were you actually doing something that arises out of and in the course of employment or not? And so we'll see some of the big debates there. Occupational diseases can be an issue. So obviously, a lot of the asbestos cases were workers' comp cases. They were also suing, suing their employee for workers' comp, also suing the asbestos companies. The problem there is it can be many, many years before it manifests itself. So there can be some really latent workers' comp claims out there. So it's possible they can't sue the asbestos company because they're bankrupt, but they can sue their employer because of workers' comp claim. What's not covered? So there are some things that most states will exclude. So employees that are intoxicated on the job, that's probably not too common anymore. But in the 60s and 70s, the whatever, I don't drink, so I don't know. What is it? The 2 martini lunch? What's a big martini lunch? I don't know. Y'all probably don't drink martinis either. That's kind of, but anyway, it used to be people would go to work and their employer would pay for alcohol, but that's not too common anymore. Obviously, you're injured away from work, but the question is, when are you away from work? All right, we'll talk to them about that. It's getting a little tricky, right? You're talking to your boss on your cell phone driving into work. Are you at work or not at work? Your boss requires you to be available 24/7. Are you at work 24/7? So we'll kind of get into that. So when are you at work and not? Heart attacks on the job, however, that one has been tested. There are some people saying the job is what caused my stress. The stress caused a heart attack. It was the job that caused it. Now, you have someone has a heart attack on the job. They also will have 3 teenagers at home. You tell me which caused more stress. It's debatable where the stress is coming from. But there are people that are challenging that part and say, yeah, there are some elements that stress-related jobs differently. And your cause injuries on your coffee break. But when does your coffee break start? You get up and you trip over your chair during the coffee break. When exactly were you on coffee break? Or maybe you're getting up to go to coffee break and the phone rings and you reach back and you strain your back. Were you on coffee break or you come back against your phone? So I wonder how many cases there have been on that. This is the one I really think is getting questioned the more, is transportation to and from work. Your boss knows distracted driver is an issue. Your boss knows you're a worse driver when you're on your phone, and your boss is talking to you while you're driving into work. I think you got a case. Your boss, what if you tell your boss, hey, I'm driving, I can't talk right now? What's your boss going to tell you? Hey, shut up, and I need to talk to you right now. What are you doing? My boss was on the phone 24/7. I mean, he was anytime he was driving. That was before hand-free stuff. So he was always on his phone. So I'm sure there have been many cases on this. That'd be a pretty good topic for paper two. You can see there's, what are the courts deciding on this now because of the cell phone, and then work from home. Obviously, I think someone has done a paper on work from home and workers' comp. There's many articles on that. You're now at home, you're at work. You trip over your dog, you wouldn't normally have a dog at work. Those are things that we're having to work through the courts. And then horseplay between employees, that can be an issue that's not covered. Obviously, every state has different things. I think some of these elements, one big issue that came up in one state was mental illness related things. Stress could be part of it, but even other panic attacks, those kind of things. Generally, that's not covered, but one state specifically said those were covered. And what they discovered were people were taking jobs just so they could file a claim and get that covered. So they're taking a job entirely to get the workers' comp. So they take the job, then they say, I have this element, and then they get covered. In California, really had to address that because it was causing some issues from employers. So there are things that are specifically not covered, but you can see there's quite a bit of uncertainty there. So what do you get if you're covered? There is a huge morale and moral hazard here because there are a lot of people that would rather be at home collecting disability pay than working. So you have this incentive. There's a lot of workers that are worried about a recession and they'll get laid off, and so they just happen to get injured right then. And that does happen. Workers' comp claims do go up significantly going into a recession. So it's obvious there are people that are filing claims because they'd rather have workers' comp than unemployment. And so, there is a moral hazard here. If you ever watched The Office, didn't Oscar have a workers' comp claim? And somewhat fraudulent, right? Or not? I can't remember. That was a pretty bizarre one where the guy with the glasses. That was a bizarre one, but yeah, workers' comp fraud was actually part of The Office. Or why do you get so medical? You do get health care coverage as part of workers' comp. You break your leg, you hurt your back, those kind of things are certainly covered. And corporate tunnel is a medical coverage. USAA, I thought it was the most bizarre thing, but they're talking about it like it's normal, but USAA hired a hand guy, a hand expert. I just thought that's weird. That's all he does is he handles hands. So that was him. He was a hand expert. And they hired him for corporate tunnel because they were just getting these massive claims. So medical, I would include, and you probably should put this in the notes, I would include, and we're going to talk about this a little later, rehab. Rehab is a big part of workers' comp. How can we get workers back to the job as quickly as possible? And that can be pretty expensive. And so that's what USA was doing with the corporal tunnel, is taking to someone that's an expert on the muscles, find ways that you can handle that. Disability, you're not going to notice this on your job. Firms have, for the most part, converged all these together. Now, they're not converged together for the company. Some of the company's covering, some of the health insurance is covering, or disability is covering, some of the workers' comp is covering, but you as a worker may not notice which of these you're actually under, whether it's paid time off, or sick leave, or short-term disability, or long-term disability, or workers' comp. You may not care as long as you're paid. So disability income comes from all these different places. It does make a difference whether you're injured on the job or not. So you could be injured off of the job, and your employer is going to pay you 70% of your pay. That's not workers' comp, that's disability. So USAA provided me short-term or long-term disability. I also had workers' comp. USAA still wants to know where I was injured because they want to know which insurance is going to pay for it. But you as an employee may not care on that. But the reason it makes a big difference is some of this is coming from something that is regulated by the federal government, and some of this is coming from something that's regulated by the state government. And so it does make a big difference on who's covering what. FLMA, I have not looked at FLMA in a while. When I was at USAA, it was time off, but without pay. And I think it's still that way. But if you don't have disability, I don't know what FLMA at USAA, why I applied so much for someone who was actually injured, because their short-term and long-term disability would have covered, but FLMA for a family member or something like that, you would not get any payment for that. The disability income, you're off, you cannot work, and you get some kind of pay. So workers' comp is a big part of that. One thing with workers' comp is they want to know, is this a temporary or a permanent thing? If it's temporary, but you're totally disabled, you cannot work. There's going to be a waiting period. That's kind of the deductible on workers' comp. So you can't work. They'll say, well, after 2 weeks, we start paying. You don't really care about that because you probably also have paid time off. So your paid time off, that's what you save up, you collect, and that's going to pay for those 2 weeks. And then after the 2 weeks, then the workers' comp, we jump in. So there is this waiting period. If after the waiting period you are covered, it may actually revert back that this program pays for everything rather than your paid time off. So it kind of depends on exactly what went on. If you're permanently disabled, this might go you might get paid your entire life. So I remember in my 1 week I spent in this department, we had some people that were on this program for 30, 40 years. They got injured in their 20s, seriously injured, and they were covered for a very, very, very long time. If you're permanently injured, but you're only partially disabled, you can go back to work, but not 100%, and you go back to work and they may make up the difference, give you another job. So the type of disability matters. The state law might give you certain pays for different limbs. You lose an arm or a finger or whatever. Obviously, that makes a big difference whether you're a construction worker or an accountant. Which of those are going to matter? I have a good friend of mine. He's a really good string-based. That's going to be his career. He has carpal tunnel, which I think is just, that's terrible. So he had to lay off for a while. But I was kind of thinking, what if he got carpal tunnel while he was playing for the Philadelphia Symphony? Would that be a workers' comp claim? It seems like it's work-related, doesn't it? And that's a big part of his job. That would be something, if he could not play again, that would be something that could cover him for the rest of his life. We're going to talk about, I'll talk about this more on the disability, but he can't play in a symphony anymore, but he can still teach. So he's not permanently disabled, he's partially disabled, but he may be permanently for the rest of his life. So it's, that's what the courts are going to ask, and that's going to decide how much he gets paid. It does provide death benefits and funeral expenses. It does provide survivor benefits. So I rehab here at the end, but the medical and the rehab really go together. What they're trying to do is reduce the medical by giving you rehab, and they're going to choose between those two. So those are kind of benefits that they provide. How do the states provide this? So states have different rules. Most states require companies to buy insurance unless they meet certain requirements. So they might let a GM self-insure because it's so massive. They're essentially their own workers' comp insurance company as it is. They're just so massive. They got plenty of resources, although GM might not after 2008. But so they might allow some to self-insure. They're going to require everyone to have something in place. If you have a certain number of employees, whether it's 10 or 50 employees, you have to have at least some workers' comp coverage, and the state law is going to require it. There are some states, and I don't know how current the 6 is, but there are some states that have state-run monopoly pools, which you can imagine are probably disastrous for the taxpayer. So you have to buy from them. There's some states that have a state pool, but also have a competitive competition as well. So the state has a fund. And I think the lady I was presenting with in workers' comp, I think she actually worked for the state-run pool, if I remember correctly. But it's been several years since I did that. So states are all different. And I'm sure this is probably a little dated as well. Again, the workers' comp just comes a part of that package policy. So if you're a small school, you employ 20 people, you buy workers' comp, you're not going to notice that it's coming from 4 or 5 different insurance companies. Your broker just puts it all together for you, but you got that coverage. I'm glad we had it because it definitely saved us a lot of money. We had to shut down our school. So when we shut down our school, our workers' comp almost disappeared. That was the bulk of our exposure. What workers' comp does is they ask for a list of all your employees and their salaries. Why they ask for the salaries? Because a big part of the benefit is disability income. So they need to know how much you're paid. That's when, I think I've told you all this before, that's when I needed that file to do budgeting or something, and they sent me the file. And I was expecting them to send me the file without the key executives because it'd be pretty obvious which one was the CEO, right? The one that's got the really big number. They sent me the file with everybody and their names for the entire company in Excel in an email. I didn't open it. I mean, I opened it, but I didn't look. Y'all don't believe me, but I did not look. I clicked off of it and I called them and I said, I can't believe you sent me that file. This is crazy. But that's what a workers' comp, I think I needed that for life insurance, but a workers' comp company needs the exact same thing. They need to know what workers you have, what are they doing, what's their salary, and based off of that, they're going to come up with a rate that they're going to use for your company. Because they are going to pay them a disability, a percentage of pay. They're not going to pay 100%, they're going to pay 70%, 80%, something like that. Just because it's tax-free. They don't want someone having an incentive to get injured so they can get the disability. All right, so what are the issues? There's a lot of issues with workers' comp. A lot of this is health insurance, and health insurance costs are going up dramatically, and so that means workers' comp costs are going up dramatically. I do think one of y'all was talking about Affordable Care Act impact, wasn't it? Someone in here is going to do workers' comp and Affordable Care Act. I sure thought like we had someone. There it is. Jacob's not here. So Jacob was going to do that. It should be an interesting case. He's probably on the Zoom. There he is. No, he's not. That's the other Jacob. All right, we got 3 Jacobs in here. So someone's going to try that. Could be an pretty interesting case. I told them make sure you have articles to find. But the Affordable Care Act, because companies they have an option how they handle their health care. How does that impact net workers' comp? I have no idea, so I'll be interested to see what he comes up with. Loss control is something I definitely noticed at USAA. I was quite impressed as we met with our workers' comp company. They were telling us how to run our business differently. They were looking at the type of claims we had, and they were telling us, you need to have someone do this, you need to have someone do this. Very, very interesting. So, they come into the company as it's kind of what we talked about in the first exam. They actually provide benefits beyond just the insurance coverage. And they do know what they're doing. That was, they insured a lot of service providers like USAA with a lot of desk jobs, and they had some ideas what we could do better. USAA probably got some experience ratings. What that means is they're going to look at your actual claims, and your premium is going to be based on your actual experience. So if you file more claims, they're going to charge you more. And they'll tell you if you do A, B, C, and D, we'll reduce your insurance rates by this much. So they give you an incentive. You can actually use that incentive to help pay for these programs. Smaller companies don't get that. So the company I dealt with, the small employer I dealt with, no, it was 100% based on their general population. And then the rate setting process can be very, very politically sensitive. So even though you have really good experience, you may not get the rates you think you deserve, because it's not always based on the data. Sometimes it's based on what the state says. Now I've heard, I think I don't listen to radio much anymore, but I've heard on the radio there is an entity that does workers' comp that advertises here in San Antonio. I don't know if you've heard it before. They advertise a lot about what dividends they're going to pay and reimbursements and those kind of things. So there's definitely a political and a public aspect to this. All right, probably the biggest issue is this one. I think you could write, maybe I should encourage Jacob to change his paper to this. I think you could write an incredibly expansive paper on workers' comp and what's happening to work. So that definition of arising out of and in the course of has been expanded by the courts. We talked about that on exam 1 with mold and with storm surge. Courts are reinterpreting these contracts, and more stuff is getting covered. The actuaries are having to deal with that. So mental illness is getting covered in some states more frequently, and trying to establish that and tie that back to the job itself. Stress-related ailments like heart disease, more and more people are making those type of claims. I know at USAA, there was a heart attack situation when I was there, and there's a lot of questions of did USAA handle it correctly. So there's the workers' comp side of it, and there's the general liability side of it. So it's not like USAA's washes their hands of it if it's not workers' comp. If they didn't handle that correctly, they didn't have the nurse show up on time, they didn't get the ambulance there inside on time, he could have sued under the general liability side, maybe not on the workers' comp. So maybe workers' comp won't cover, so it doesn't mean he's not covered. But yeah, they were, it was interesting watching a lady named Tom. She was the one that handled it, going in detail. Who showed up first? What did they do? Whom did they call? Those kind of things are really, really important to companies. Industrial disease, obviously, asbestos. One thing I thought was interesting, and I've looked for it. So flight attendants, they sued on secondhand smoke. That was a really famous case. Let's see if it's in Wikipedia. I like Wikipedia better than anything else. So is passive smoking, secondhand smoke, is that a workers' comp claim? Or is that a claim against the tobacco companies? And my guess is both. So y'all don't know this because I don't think any of y'all are alive when smoking was legal on planes, right? Any of y'all ever been on a plane where people are smoking? Probably never, right? Can you imagine there was a time where you could smoke on the plane? They did at one point say you have to move to the back. So if you're a smoker, you had to go to the back, but that didn't do much. So it was just pretty, I'm real sensitive to this cigarette smoke. But at the same time, you gotta understand a chain smoker getting on a 7-hour flight, it's going to be a problem, right? It's a challenge. So there was a time where smoking was allowed. It was in the back part of the plane, but if you're a flight attendant, you had no choice. All day long, you're getting exposed to secondhand smoke. And flight attendants were getting lung cancer beyond the average person out there. So they had a strong case. My guess is they probably sued mainly the tobacco industry, but if I were they, I probably would have sued Delta and American Airlines as well. So I don't know. That would be an interesting one to add to a paper too, right? There's so many topics here that are just, I think, really, really fascinating. But that to me would be an industrial disease. So I think that would be interesting. And then workers' comp often becomes kind of, the court says, no, it really wasn't work related. You really don't have a workers' comp claim here, but there's no one else to pay for this. In workers' comp, they got a lot of money. Let's put it in workers' comp. And there have been cases where judges would say, yeah, it probably doesn't belong here, but let's put it there just so someone pays for your injuries. But I do think the biggest one is the changing role of work itself. So work from home. So I think that one all by itself could be an entire paper too. So I'm surprised none of y'all picked that one because I just think that one's so interesting. That would be I'm sure if I put that up there, work from home and workers. I'm just guessing stuff is going to be about 69 million results. What happens? Are telecommuters covered under workers' comp? How does workers' comp work for work? I mean, it's all of those, right? So why don't y'all pick that topic? That just seems like a really interesting topic. Part of the issue is the equipment. So more and more employers are providing equipment to their workers, whether the computers or the lines. So there's more stuff that the company actually owns in your house. So that's part of it. Driving to work, distracted drivers. There's an article on that. I can get it, the copy here. It's still there. Distracted driver collects workers' comp benefits. A distracted driver was awarded workers' comp benefits in Virginia. Donna Turpin, she's a nurse, was on call. So that's kind of back to it. People that are on call, they're not actually working, but they have to be ready to go at any second. As most on-call employees, she was required to be reachable by pager or phone. Y'all even know what a pager is? I guess we still have pagers, don't we? While on call. In this particular case, the procedure for contracting employee was this. The employee was contacted through a pager, and she had 15 minutes to reply. She was then paged a second time. She would have been called on her personal cell phone. If she didn't respond, she would be called on her home phone. So that's it. So that's part of her job. She gets in trouble if she doesn't reply, right? Because she's a nurse, someone's suffering. She needs to get back there. They have, some emergency. In order to be available, she always had to keep her beeper and cell phone with her in her front pocket. According to the facts, at the time of the accident, Ms. Turpin was driving home from work when her cell phone light caused her attention and caused her to glance down. Subsequently, she drove her car off the road on the gravel, wrecking her vehicle and injuring herself. All right, how long did she look down? That might have been something vague. I could see this, right? I do not touch cell phones anymore just because I've had some close calls where I just look down for a second and I look up and it's like, my word. I remember once I did that, I was coming up on the freeway and the traffic just stopped because there was a deer on the freeway. I wasn't expecting everything to just stop, and I just glanced down for a second. When you're going 70 miles an hour, a second is what, 100 yards or something? So after that point, I was like, I'm never touching that. I turned my phone off and I put it out of the way. It's just like 1 second is massive. I don't know how fast she was going, but I can see that. Now, was that her fault or was that her employer's fault? What should she have probably done? She probably should have stopped on the side of the road and checked it, right? That would have been, if you're on call, that's probably what her employer should have told her to do. But you can't always do that, right? If you're on the freeway, there's construction, you can't just stop on the side. So she sought medical payments from her employer for the whiplash she suffered. She argued she hadn't been glanced down. She wouldn't have had this problem. The accident did not arise out of her employment, so that's what they're arguing, right? The employer said no. So what in Virginia said, if there is a causal connection between the injury and what the employer requires, then there's a case there. Now, has Uber been sued for workers' comp? What does Uber argue? They argue what? They're not our employees, right? They're contractors, they're independent, they need to handle that themselves. What is the UK arguing? They're your employees. That makes a big deal for Uber, doesn't it? That's going to raise their costs quite dramatically. The injury must be able to be fairly traced to the employment as a condition and does not originate from a hazard which the claimant would have equally exposed apart from her employment. Now, she's probably arguing, if it wasn't for this employment, I'd be a really safe driver. I had my phone off. No way. We may not believe that, right? We might think, oh, yeah, sure, you're going to watch your phone anyway. You're probably checking it because you might have thought it was your kid or something. But how do you prove that, right? So who knows? She used her cell phone for both personal and business-related calls, paid the bill from her phone. It was unclear if the call that distracted. Now, what are a lot of employees doing now? They're saying, use your personal phone and we'll reimburse you for that. Well, that opens up a whole Pandora's box, doesn't any of y'all have that happen? We'll help pay for your iPhone. And that way we don't have to buy a work phone for you. That saves them a lot of money. You get some reimbursement. Boy, that creates a whole new issue. So here's a case that they said a case where the claimant was engaged in a work-related phone conference with the employer-provided cell phone while driving. Their employer instead encouraged the commission to follow this case and find that Ms. Turbin was not performing a required act, one that would distract her from the safe operation of her vehicle. Now, I've had students on Zoom while they're driving. I'm like, I don't know you're doing that. Don't blame me if you have an accident. They are hands-free, but we are talking finance, a pretty exciting topic. So, I don't want them to get excited and have a wreck. So ultimately decided the employer was liable for the compensation and stated it didn't matter who footed the bill for the cell phone. What mattered was, and this is a pretty strong case, right? She has to do this for her job. So now, what if they had a policy that said, you've got to respond, however, you can only respond if you can safely pull over and check at that point. If that was part of their policy, maybe, I don't know, this kind of depends. What does it mean for employers? Many states across the country completely ban use of cell phones while driving. Others are limiting their use. So part of it is the law itself. An employer can't require you to do something that's illegal. So that's probably going to change as well. So the best thing to do is policy, right? Why do we have to sit in these long meetings on policy? It's so that they can avoid their liability, right? It's not because they think you're going to be safer, it's so that they can say, hey, we told them and they did it anyway. So anyway, so there's definitely some issues there. People who drive car work, salespeople, are they on the job? That's their job, right? People who work at other people's sites, you're a consultant, you get injured on someone else's site. Do you sue them for being negligent, for not doing what they needed to, or do you sue your employer because you're required to be there? I remember UTSA, some things they would do that I just thought, boy, this is not too smart. They had these escalators that they were told were too fast. So what did they do about it? They put a sign up that said, warning, escalator very fast. I'm thinking, well, if I get injured here, I can take a picture of that. You just admitted that you put me in this dangerous situation. I remember once I went into the cafeteria. It was like a skating rink. I like slid 6 feet. I go and tell them, man, you need to do something about that. Guess what they did? They put up a sign, warning, slippery floor. I was like, no, you need to go dry the floor. It was really dangerous. Don't put up a sign and say, hey, we're negligent. Do something about it. So partial retirement, that's becoming a big issue. There's a lot of firms that don't want to lose these great employees. They say, hey, you know what? We'll let you work 10 hours a week. But now they have new issues. They're not as mobile as used to be. They're hearing issues, sight. Do you have special requirements to make sure they're taken care of? And so that's become an issue for some places. The nature of the work itself, obviously keyboards. And what are autonomous vehicles going to do? What if you get a call from work and you're in your Tesla and say, oh, I'll just let the Tesla drive for me? Is your employer required to do something like that if they know you're doing that? You know, that's going to become an issue. Eventually, autonomous vehicles certainly can become an issue. So I think there's a lot here, and there's certainly a lot of articles written on this coming really. So if any of you want to change your topic, let me know. I think it would be really interesting. I'm kind of hoping someone will, because I find this really interesting topic. It's a topic I don't deal as much with as the auto and homeowners insurance. Can y'all think of anything else that's going on in the work life? One thing we tried at USA, I don't think it's as popular as it used to be, what was the shared workspace. Have you ever heard that before? So 3 people used to send, because one person works 2 days a week, someone else. Huh?
They still do that.
So that creates some carpal tunnel issues, doesn't it? Because everybody has a different kind of height and all that kind of stuff. So I remember USA tried it a good 20 years ago, and it didn't get, they did it with the IT people, and they gave them lockers and they all shared desks. They didn't like it. They didn't like having somebody else's spouse's picture on their desk and that kind of thing. But so I know they had to rework it. So they probably got it so it works a little bit better now. But companies have a lot more workspace now because they do have people working from home some. Are there any Zoom issues? People on Zoom, can you be injured in a special way because you're on Zoom? So yeah, not sure exactly what's going on with those. But anyway, there's the work life is changing faster than the insurance rules are. And I'm sure there's a lot of companies that are dealing with this. Fraud is a huge issue on workers' comp, just like it is for disability, just like it is for Social Security disability. It's just a huge, huge, huge issue. Now, according to the Coalition Against Insurance Fraud, so first of all, any number they give is going to be inflated because that's their job, right? So yeah, you may not be able to trust it, but they say we're spending tens of billions of dollars on false claims. The most common forms of workers' comp fraud are a worker gets injured away from the job, doesn't have disability, doesn't have health care, so he convinces his buddies to take him to work and throw him down the escalator, and then, you know, say I got injured at work. That's for someone who doesn't have good coverage anywhere else. Yeah, has that happened before? Yeah, definitely that's happened before. Inflated injuries. I'll show you some videos maybe next class of some inflated injuries. A worker has a fairly minor injury, and they lie about it and make it more serious. And they're definitely, I can't remember the Oscar case if that was it or not. It was, I have to go back and watch The Office. I'm sure I can YouTube it and find it. I can't watch The Office all the time. Some of it is just too awkward for me. Some of the stuff Michael would say is, oh, that's just, I can't watch that. So I don't know every episode. So inflating injuries, and then faking injuries, fabricate an injury that never really took place. You know, there are certain soft tissue type of injuries that you can certainly, you know, whiplash kind of things that you can certainly fake. Not that whiplash is fake. There's definitely whiplash that's definitely genuine. An old injury. So you got injured in, you know, college football or whatever, your knee problem, and now you pretend like you banged your knee at work and you try to get cover for that. That can certainly be a case. And you just overstay your welcome. You know you're back 100%, but your employer calls and say, no, it's still a problem. Like, we can't do anything. I'll show you some videos of that. That's pretty shocking. So there are quite a few related to the worker themselves. Sometimes they save you, and this is probably where the numbers are most exaggerated, because it's not workers' comp as much as it is professional liability, where a doctor orders extra tests that really aren't necessary. And workers' comp has to pay for that. But that's more the doctor worried about being sued for professional liability more than it is kind of a fraud. And it's hard to call that fraud because a lot of times they'll actually find something. So if they order a test they don't normally order and then they find something, you know, it's hard to say that was true fraud. We'll come back to that, to some of these, especially the employer side. What about the employee side? What about the employer? So the employer knows that their premiums can be based on compensation, so they'll just underreport their payroll. They'll exaggerate it on the lower end, and then they'll pay a lower premium. They inflate their experience. They try to make it look that they're less risky than they really are. A lot of times with insurance, if you change carriers, they know there's something up. Usually you change carriers when you've had some bad experience because you've been a bad customer. And so that's when the insurance companies can be a little bit leery. And then evasion, the employer fails to obtain the coverage for their employees that's required by law. The workers are deceived into thinking that they're covered when they're really not covered. That can be bad for the worker, obviously. I've heard some pretty sad cases. I know one man in my church, he quit his job and started his own construction company, and he did not buy insurance. And he had a bad fall from the second floor, hit his head, seriously injured, just completely wiped out the entire family. We tried to support them as much as we could, but it was hundreds of thousands of dollars. You know, I don't know why someone would do that. Obviously, construction work is very dangerous. I think if I'm going to start my own business, I'm going to make sure, you know, I know this captive insurance costs thousands of dollars, but if you can't afford it, you probably can't afford to start your business. So construction is a big deal because there's a lot of mom and pop in construction, whether it's, you know, painters or whatever. So there's probably a lot of people who don't have coverage that probably should. All right, so what I want to do next class is I want to give you a few of these examples. I might find a few more. And then I want to finish up these last few here. And we might get to the numbers next time. So we are getting a couple of classes ahead. In fact, even more than that. So I want to spend a little more time on the pricing side if we have more time. So bring a calculator next class just in case, all right? And make sure you've got the control over the decimal. I can never find that thing, all right? So make sure you know how many decimals you have and have all that, because we're going to be dealing with some pretty big numbers, all right? I'll let you out early because I don't want to start in the middle of this. Talking workers' comp, we're almost done with workers' comp here. Interesting field. I still haven't had anybody say they want to do workers' comp. One was talking about it, but it'd make a great paper too, because it's just really in the news right now. A little bit on fraud. I won't say too much, but just give you some sense of fraud. Oh, I thought it was on. Sorry. Second. Yeah, these screens go off automatically and then forget about them. It's hard when you're finding workers' comp. This particular video is called workers' comp fraud, but sometimes it's disability income. That's a life insurance product. Sometimes it's Social Security. That's not workers' comp. That's a disability product. This one says workers' comp. You can't always be sure though, but the fraud is all the same. It's someone who's pretending to be injured who's really not injured. So the question is, how much does it really cost the system? Probably less than what the forecasters say or the people who say, because they have an incentive to inflate them.
Compensation can be a lifeline for people injured on the job. It can keep you afloat financially until if and when you're ready to work again. But billions of companies or dollar cracks are being paid out in bogus claims, and some companies say enough is enough here. Tonight, we will take you inside one company that is fighting back and seeing results. Does this guy look like he suffers with a bad back? Watch as he helps load his truck with heavy furniture. He makes several trips up the ramp, at one point lugging a refrigerator. Julio Recinos apparently wants you to think his back is so bad, he can't work at all.
He's claiming just recently he cannot bend, stoop, squat, lift anything heavy.
And you're saying all of that right there. Until a year ago, Julio worked at Guess Jeans in maintenance, but he claims a back injury left him with pain so severe and so constant, he can barely stand.
Well, this far outweighs any work he was ever doing at Guess Jeans.
And this man who's currently under investigation also works for Guess. He claims to suffer with a bad right shoulder, the same shoulder you see him use to back up his car.
Every claim I've been assigned to thus far by Guess, I have pictures like this.
Perhaps these two workers had no idea Guess would fight back when they applied for long-term disability. But with thousands at stake, Guess called in Ted Kerner, a private investigator who exposes people suspected of cheating the system.
And we're sending a message. We're sending a strong message.
Kevin Saucier heads up the safety program for Guess Jeans. Fact is, they believe so strongly about their safety record and tough policy on fraud, they opened their new LA manufacturing plant to our television cameras for the very first time. Guess employs about 1,000 workers here. They say in 6 years they've reduced the workers' comp claims from 250 to 33.
So why would they do that? The insurance company is paying for it. Well, it reduces their workers' comp insurance. It's better for the workers, right? You hope employees have an incentive. I wouldn't think of Guess Jeans as being a dangerous place to work, but a factory is also always a little dangerous. Now this is a pretty positive one. You can certainly see a negative spin on the company, filming their employees away from work. But they've got a pretty positive spin on this.
In 1991 and 1992, we spent about $1.9 million on workers' comp. We've reduced it down to $200,000.
So 1.9 million on a 200,000. Now, again, he's not talking about insurance. I don't know if that's his cost or if that's the cost that passed on to the insurance company. Workers' comp is generally, you pay what you're going to receive. That's the general way. You talked about that on paper one, right? With corporations, a lot of times the insurance is in case there's a major loss, but essentially your premium is going to match what you get paid back. And so they probably have some strong incentive to reduce these claims.
That nature injury or fraudulent workers' comp claim, we're going to get you.
We caught up with Julio sanding floors. He was fired from Guess last fall and has since filed a claim. We asked him about his bad back.
The doctor say, hey, you're ready, go to work to regular. But so much pain.
Now, I contacted Julio's attorney, who has not yet seen the videotape and had no comment. Guess, though, says it will prosecute anyone suspected of insurance.
That's the other thing, it's illegal. You go to jail for fraud, and it's pretty intensely. Police do go after it mainly because it's pretty. You got the evidence right there. It's pretty obvious. Have y'all seen the videos of the insurance fraud? Someone throws himself on the hood of a car, kind of thing. You see those? Those are illegal as well. Like I said earlier, I need to get a dash cam for my car one of these days for that very reason.
It's fraud. If you know someone who you suspect is cheating the system, because remember, as a taxpayer, you too foot the bill. Call the insurance fraud hotline, toll free.
Now she says as a taxpayer, but that would be Social Security. That's not workers' comp. Social Security doesn't pay you disability because you got hurt on the job. It's any disability. So I'm not sure what she means by taxpayer. But you do pay for workers' comp when you buy Guess Jeans or anything else. It is a cost of doing business.
On the screen there, area code 800-795-4451. Paul?
Peace Lover, football hero. Want to know why you're paying more for insurance? You could blame these guys. Watch what happens when Extra goes after suspected workers' comp cheats.
Want to see if we can get quick work with it.
Records a firefighter falling in the circle.
And yet another hidden camera captures a golfer on the tee, never realizing he's being watched. But why are these weekend athletes under surveillance? Well, because each one claims they cannot work because of on-the-job injuries, and all collecting workers' compensation benefits. Fraud is a big problem. Experts say 1 in 10 workers' comp claims is bogus.
Yeah, experts, so they tell us experts, 1 in 10 seems a little exaggerated to me. And if you think about it, I mean, these people have to radically change their lives. That's the same video we saw before. They have to radically change their lives. They can't go outside anymore. You know, I forget there was one really, really interesting one in here. I don't know if I can find it. And that's what you want, is to go on national TV at midlife without a shirt on the beach and have the whole nation watch you swimming. So it's another incentive not to commit fraud. But anyway, you can watch these on your own if you want to get some examples of these. It's certainly an issue for this industry. This one's a little too painful to watch. But this guy claimed to have the mentality of a 6-year-old. And so now he had to pretend like he was a 6-year-old every time he went outside, and he finally caught him. It was pretty embarrassing. So he had to pretend. That's all acting. He's perfectly fine. He's out playing golf. The worst part of this scene is when they catch him playing golf and he has to suddenly start acting like a 6-year-old again, when he's been, acting normal. I have to wonder, someone who hates working that much, that they're going to that radically change their lives so they can get paid without working. If you're that case, I would say change careers and go do something else. It's just pretty pathetically sad.
In that situation, what made him, did they see it on the video, what made him act as a 6-year-old? Was it like stress?
Well, he said he got injured on the job.
When Mark Cohen put in a disability claim on a slip and fall accident, he had a myriad of different maladies to choose from.
So slip and fall, I guess he said he hit his head or something. Yeah, he probably should have picked a different malady besides that. I don't know why he picked that. Maybe he thought he's a really good actor. He's doing a good job here, really good actor, and he could make it seem correct. But boy, I know some people say, well, if he hates his job that much, there's probably something wrong with the company and the workload and all that. I don't know. I don't know any job that would be that bad. There's many, many more. You even notice when I put that up there, a bunch of other videos. There's that other video we just saw, but a bunch of other videos come up as well as my Saturday Night Live watching. This one is pretty interesting. Both these couples, both of them. Now this is a disability fraud. So disability fraud, workers' comp fraud. They're two different businesses. They're both by the insurance industry, but disabilities on the life side and workers' comp on the P&C side, so different companies. You can't get your disability and your workers' comp from the same company. Your company has disability coverage for you that comes from the insurance side, or they cover it themselves. And whether you get injured on the job or not on the job, you're covered either way. They care because of which entity is going to pay for it. All right, so there's fraud. We talked this earlier, and this one I really noticed in that 1 week I worked in risk management. It's the claim admin. So this industry, I think, adds tremendous value. They know what they're doing. They can take care of the paperwork. I was interested in the one meeting I did go in. It was a stack of paper like this. We just went through case after case after case. And the firm, the insurance company, knew our employees extremely well. I mean, they were his first name. I remember them just saying, there's a lady named Mary. They were asking about, how's Mary's hand? How's she doing? And they were saying, well, we talked to her the other day and it looks like she's getting better. I think we can get her back to work. case after just stacks of envelopes are going employee by employee. It makes the employee actually feel somewhat special. They have this person working with them, trying to get them back to the job, trying to get them healed. So a company doesn't want to mess with that. That's a lot of employees, a lot of work. If you have a firm that does nothing but that, they can get some productivity and some economies of scale out of it. The issue with this is if the insurance company is doing this and not the employer, it may be too distant. The employee may not feel like they're really being taken care of by the company. I would guess with the ones I saw that the employee may not even realize they're not dealing with an employee of the firm they deal with. They really work so closely together. But you do have to get the employee pretty quickly. Once they're out of work for a while, it starts to become, kind of a habit, a new lifestyle, and boy, it's tough to get them back. So you do have to react pretty quickly. And that's probably another advantage of using an outside firm is that you can, they're going to have the resources to move. If you do everything internally, there's some things you really probably don't want to do, like the actuarial resources. It was interesting to me, USAA obviously has a lot of actuaries, but they don't have a workers' comp actuary. But USAA does have a health insurance actuary, and they do have a pension plan actuary, and they do have an exec pay actuary. So companies do hire actuaries outside of even insurance. And so you can get those jobs, and they're pretty lucrative jobs, mainly because you're the one actuary that's the expert in that. So you're kind of, no one knows your job other than you, so you're kind of protected. But most firms do not want to hire an actuary to do workers' comp because you got to set up the reserves and all that. So you're probably going to outsource that to an insurance company unless you're just so massive. It's possible a firm like GM would actually hire a workers' comp actuary to set up the reserves, and they do everything internally, but it had to be a pretty large employee. USAA did not have a workers' comp. But your goal on the claim administration is to get the worker back to work as soon as possible, and whatever accomplishes that works. One thing I'm really interested in, but it doesn't really work as much in the US as it does in Europe, and that is just forget workers' comp, disability, health insurance. Let's just all merge it all into one big program. So let's just harmonize it all together so it doesn't feel like 3 or 4 different types of insurance. Very hard to do in the US, much easier to do internationally, mainly because in the US, we have the states versus the federal government. Some things are regulated, like employee benefits are regulated by the federal government. Insurance is regulated by the states. It's really hard to get those two groups to work together. There are companies and insurance companies that are trying to get these programs merged together. It's still separate coverages, but make it look like it's all one thing through the insurance company. And especially, and I certainly at USAA didn't notice a difference in the different products. So the employees are more and more not noticing whether it's workers' comp or disability or sick leave, that it all seems like one. Because it is frustrating to have all these different programs. And then getting people back to work. Firms have return to work programs, especially lower paid workers. They may actually prefer workers' comp. How do you get them back? So you have an entire team that is going to sit, and this is what I saw at USAA with the workers' comp experts, actually sit within each employee. It's going to take some time. It's going to take some money. But do a job analysis. What can they do? What are they capable of doing? And if you're going to be paying them $50,000 a year on workers' comp, and they can do another job that's not as difficult, but at least they're doing something, at least you get something for that pay. And so you match the job up with the workers' capabilities. You may have to provide rehab services. I went through rehab services once, and boy, it was not all that valuable to me. Everything they did for me, I could have figured out in the first 5 minutes I met with them and just done it myself. So it was kind of a waste. But some I'm sure are really, really valuable. In my case, it didn't work very well. You may have to transfer the worker to another less physically demanding job, at least for temporary purposes, but then you got to monitor them. Is that for 3 months? Is that for 6 months? Is that for 5 years? So it is time consuming, it is expensive. And if the worker just doesn't want to come back, the program may fail. And you may have to do what these firms do. you hire a private investigator, that's expensive. And they're gonna go around and video your employees. Your employees may not like that, that may find that intrusive, but that's the kind of thing you'd have to do. So workers' comp is a big part of a lot of companies' expenditures on insurance. All right, so let's get into some number crunching. So P&C pricing, we're kind of on schedule for this class. And we haven't done much number crunching until now. So if you have a laptop with a calculator or you have a calculator, you might need it. Maybe not tonight, we'll see. But if pricing in insurance is unlike any pricing you've ever seen before. It's a very unusual business. It was interesting last night in Investment Society, they were talking about Berkshire Hathaway, and they had a whole spill on float and the importance of float. And that's a big part of what we're talking about here. But pricing for insurance is a discounted cash flow. I don't know what they ask on the actuarial exams. What I do in my life insurance class follows pretty closely with the actuarial exams. What I do in this class doesn't, mainly because the math is a little too much for this class. But it's the same process. It works the same. It's just different mathematics. We're doing it from a financial standpoint versus an actuarial standpoint. And we're going to focus in on the entire premium. So in my life insurance class, we only worked on the net premium, which is just what you're paying in claims. Here we're going to look at the full premium. So the full premium includes the pure premium. The pure premium is the present value of your claims. And the discount rate we're going to use is expected return on the investments. So it's entirely a float kind of analysis. So we got to figure out what claims are going to pay out and when are we going to pay them out. So if it's auto insurance, it's pretty straightforward. People pay us premiums every month. And if they have an accident, they're probably going to file their claim within probably the day of, right? I mean, can you imagine you have an accident, you're going to wait a week to file it? You're probably going to call the company from the accident scene. You may even take a picture and send it in from the accident scene. I mean, it's gotten much, with smartphones, it's gotten much faster. And so it's going to be what's called a short tail line. Short tail lines, auto insurance, auto physical, not auto liability necessarily, but auto physical. It's probably going to be a 2-month, 3-month type of line. And then long tail lines like asbestos might be decades. And so that's what you're looking at is how much you're going to pay out, when are you going to pay it out, and what are you going to make on the investments. So really three components. The investment side, the claim is what? What are those two words we keep using? Yeah, frequency times severity. So the claim side is the frequency, what's the probability? Don't think of frequency in the timing, think of frequency as the probability of it happening, and if it happens, how much you're going to pay out. And then the last part is time. This is going to happen very, very quickly after they pay their premium, or it's going to happen much longer after that. So when we price a policy, those are the components we've got to have. I'm going to specifically give you frequency and severity, so you don't have to worry with that. I'm going to give you the investment rate, and I'm going to give you time. So I'm going to give you all of those. Most insurance companies know this. So at UTSA, we actually knew the average tail of our products. When I was there, it was 18 months. So typically the process was once they sell a policy, everything's taken care of within 18 months. Auto insurance might be 3 months, homeowners insurance might be 9 months, and then the liability side might be 2 or 3 years, but when you average it all out, pretty short tail lines. And then we got to add on top of that loading. So the word loading is extremely important in insurance. It's everything you add to the premium that's not part of the claim piece. So the loading is your expenses, again, on a present value basis. It includes those loss adjustment expenses and those underwriting expenses. We're going to look at both of these. And the LAE is actually closely tied to frequency and severity as well. And we'll see that in the example. And then you have to make a profit. So the gross premium is the pure premium on a discounted basis, plus your expenses on a discounted basis, plus your profit. We're going to put all of those in there. I'm going to leave one little element out in our equation just to keep things simple because it can get pretty messy. But that's what we're after. And then the frequency and severity, that's what actuaries are all about. They've got to sit down and figure out we saw it with the credit scoring, the age of the driver, where they're driving, the type of car, how many miles they drive, what their credit score is. They're going to put all that together. All of that is to get us that frequency and severity number as close as possible. You don't have to be perfect because you might have 50 different categories. One category you might underestimate, one category you might overestimate. They need to all net out those. And that's probably, there's probably some of this offsetting, that some they over and some under. There's also probably some that all move together. So, the fact that people are buying more SUVs is having an impact. That's probably going to affect people no matter how many miles they drive or whether they're young or old. It's probably going to have an impact on everybody. And then there's some things that might truly be offsetting and you just have that good correlation benefit. So that's the formula we're going to be working with. Warren Buffett, in the article we read, he says insurance premiums are really borrowed money to be paid back with claims and expenses. So he says it looks a lot like debt. Float is that timing difference between receiving the premium and paying this out. And then the cost of float is essentially your cost of capital. It's your cost of borrowing money for your policyholders, except for you're going to pay them back in claims and expenses. And then the float itself, it was interesting last night, I'm watching this person who hasn't taken this class talking about Warren Buffett. And he said, Warren Buffett, Berkshire Hathaway has more float than any other company in the world. What did he mean? He was just looking at the reserves. Their reserves are larger than any other reserves. This means they're the largest insurance company out there. So insurance reserves are the float. And that's the way Warren Buffett uses it. Why? Because the insurance reserves are that part of what the insurance company owes that they haven't paid back yet, and they'll pay it back over time. So there's a close tie to what we did earlier in the semester. When Warren Buffett asked, should you discount reserves? Yeah, you definitely should discount them because the state requires you to compensate your customers with lower premiums by taking consideration that timing difference. Now, key to this is cost of goods sold. That's essentially what the claims are, your cost of goods sold. But with insurance, the really interesting thing is you're talking about a product that you don't know your cost of goods sold at the time you sell the product. You don't know how many accidents there are going to be. You don't know how severe they're going to be. Especially, we saw that right with the homeowners insurance and the mold claims. They priced the product and then the claims came in, I forget what, 9 times higher than expected. And the severity was 10 times or whatever. I can't remember the numbers. So you don't know in advance. So there's some risk there. And that's kind of the downside of talking about float being free or negative, that you're getting paid for float. You are, but you have tremendous risk that you can suddenly see this thing jump. So auto physical is probably the shortest tail line there is. Homeowners is kind of in between, but catastrophes can take months because you have a major area that's destroyed. I don't know that Medina had the fire, right? This last week. I wasn't paying attention. I don't know how much property was destroyed. Did y'all see any articles?
I don't know, but it was like snowing ash and burning.
In Bernie, wow, that far over.
Yeah.
I know some houses got destroyed because I know.
See it from Comfort, Texas.
Wow. Do they know the cause of it?
I haven't read up
Yeah.
on it.
Yeah. So I mean, I doubt it was that many houses, but there probably were some houses either destroyed or damaged. So that probably will not be. It's going to take a while. You can't rebuild a house just overnight. Whereas you can fix a car pretty fast. So homeowners, Even in normal times, it just takes longer. It depends on the, if it's a kitchen that caught on fire, because you have to hire contractors, it takes a little longer on a house than a car. So it's gonna be a little bit longer tail, but usually if people have a claim of homeowners, they're gonna report it pretty quickly and are gonna start contracting pretty quickly, especially if it's inconvenient. And as we said, the asbestos is very, very long tail lines. We're talking decades there. All of these have to be taken into consideration. The timing, the float, all of that has got to be in the equation. So this is how it worked at USAA, just to give you a sense. I was in a department where we were responsible for all assumptions related to investments. And so I got involved in this, and it was pretty interesting. So I worked with the actuaries on this equation, and we had to file this with the states. So the actuaries produced this to file it with the state. And they needed our return on capital. And so I had to say, what was USA's required return? What return do we need? What model do you think I used? I need to figure out what return USAA needed. Is there any model you can think of that gives you a return on capital? Have you ever heard of this? CAPM. I use CAPM. Why do I use CAPM? Because it's in every textbook and every finance book out there. So the states can't really argue with that. So I use CAPM. So I needed the beta for USAA. Where do you get a beta for USAA? It's not publicly traded. So I went out and found the 11 insurance companies that are publicly traded that look the most like USAA. I got their betas. I adjusted them for USAA's net worth and solvency, leverage. Filed that with the states. No state ever questioned that. Gave me my return on capital for USAA. That went into the equation. And I also needed our return on investments. The state of Florida was the pickiest. The state of Florida asked, what's your return on investment today on the portfolio you currently have? And what's your return on investments on assets that you're going to buy when these premiums come in? So I had to give them those two numbers. And then the actuaries had to figure out how much of the return is coming from existing investments and how much is going to come from new investments. They were quite precise. So I had to provide those two numbers. What I loved about this discussion is when I met with the actuaries, is they knew the capital asset pricing model as well as I did. Here I'm a professor that teaches it, and they all knew it backwards and forwards. It was a great meeting. I was really shocked at just how much they knew about the investment side, because I sure didn't know the actuarial side as well as they did. So we use a lot of these theories in finance, mainly because you have to have something for a basis. You can't just pull a number out of thin air. And we have these models that show that. And we're going to talk about, once we filed that, what did you do with that information? That's where it gets a little squirrely with the regulators. You don't always request what the numbers say to do. But these are pricing actuaries. That's what pricing actuaries do. They have to file their rates with the states. Remember Texas? Do you remember what the Texas rules were? File and use. Y'all remember that? Texas is a file and use state, which means what? You file your rates, you start using them. The state doesn't like it, they can come back and disallow them, but you just go with them. Some states like California, you have to file and get approval before you can use your rates. And sometimes California is really, really slow. So you can't change your rates. You got to keep using the rates you used last year until they finally approve them. So it just depends. Most of the filings we did, they didn't come back and ask me questions. The state of Washington was the only state that came back and asked us questions. I can't remember. I think they were questioning how I came up with the beta for USAA or something. I can't remember what it was. It was some technical question. So we just replied to that. But we've got 50 states, right? And you got Guam and Puerto Rico. Every single state is different. So if you're an actuary and you're a pricing actuary, you're probably going to be a pricing actuary for a group of states, and you're going to be responsible for coming up with the rates, filing them with the states. Some states are a piece of cake. There's no issue at all. You just file and it's done. They don't ask any questions. Some states are a major pain. Now, I think Georgia's the one they said was the worst. It wasn't that the state was the worst, but it's because in Georgia, you had to do this in every county. And they're like, it's 50 states, and then you got Georgia, which is another whatever counties. They just dreaded it. So if you're going to apply to be a pricing actuary at an insurance company, they're probably, if you're the newbie, they're probably going to give you the worst states. I remember when I was doing accounting, you had to file all this stuff state by state. And as a newbie, yeah, they said, okay, Ron, you're going to do these states. And I knew they were the worst states, and they were the painful ones. So, but it's a good way to learn, you know, you get in there. But it's an actual process. Every firm has it. So let's talk about required return on capital. So let's make sure you've got this in your finance class. Extremely important. I'm going to guess that they asked this on the actuarial exam. So do y'all remember Miller? Anybody in there can explain Miller-Modigliani to me? Do y'all remember it? Can you?
Like levered, unlevered. I know they use it. Well, he talked about it in my real estate class earlier this week, and then they also mentioned it in my cases course. But I mean, just using debt to lever your firm.
All right. Yeah, that's what it's related to. So what did they say? Can you get the word optimal into your discussion of Miller-Modigliani? What were they asking about?
Well, one of the courses was like using your so they're trying to resell the company to private equities.
Okay.
And they just wanted to use the debt to lever the firm. I don't know.
All right. So what is debt? What does it do? So they're asking about what is the optimal capital structure. So anytime you hear Miller-Modigliani, so if you get that, this is the question I love to ask in interviews. What did Miller-Modigliani say about capital structure? And so the first thing we say is they're asking, is there an optimal capital structure? Is there an optimal mix of debt and equity that maximizes the value of the firm? All right, so you start with that. I might ask this on the exam because Miller-Modigliani is pretty important. I don't know if they won Nobel Prizes because I think one of them passed away too early. Maybe the second one did, and I don't remember. I can never tell which one's which. There's just known as M&M. So one of the most famous concepts in finance, and they're asking, does it matter? Does it matter if a firm is 40% debt, 60% debt, 80% debt? Does it matter? And their initial answer, you remember what their initial answer was? Does it matter? You may remember, what did it first say? Before taxes, before bankruptcy, does it matter? Their answer to that was, any takers? No, that's right. I mean, are you saying no, you're not a taker, or the answer was no to their question? Yeah, the answer is no. They said it doesn't matter. Doesn't matter if you have 20% debt, 40% debt, 6% debt, does not matter. That's before taxes and for bankruptcy. And why do they say that? Because the cost of capital of a firm is that, right? Weighted debt times the cost of debt. What's the weight of equity? The cost of equity. You all remember that, right? That's before tax. Which is more expensive, the cost of debt or the cost of equity? Which is more risky, equity or debt? Well, no, which is more risky as an investor? If the firm goes insolvent, who loses 100% of their money? The stockholders do, right? And the bondholders get something back. So equity is more risky than debt. So cost of equity is always higher. So it might make sense to reduce your weight of equity, increase your weight of debt because debt is cheaper. What's wrong with that argument? If you increase your weight of debt, does anything else change? Well, your weight of equity comes down, but does anything else change? What happens to your cost of equity if you use more debt? You just mentioned levered and unlevered beta.
Yeah, let's think.
Well, if you use more debt, your beta does what? More debt. Y'all should have had this like in 3013, which is what, like 7 years ago, maybe, I don't know. Some of y'all are part-time students. More debt equals what? Y'all should have had this. This is pretty critical stuff. Levered beta, you can even look it up. Levered beta, you'll probably find Miller-Modigliani in here. Not if you get that, but levered beta equals unlevered beta times 1 plus, ignore the taxes, debt or equity. You add more debt, your levered beta is going to be higher than your unlevered beta is your beta without any debt. If you add debt, your beta increases, all right? I'm telling you stuff you better know before you interview for jobs because they're going to assume you know this stuff. All right, remember KE equals the risk-free rate plus beta times the market. This premium, so more debt does what? Increases your beta and increases your KE. So the more debt you have, it is true, debt is cheaper than equity. So you increase your weight in debt, you have more debt, and that's cheaper. But as you increase your debt, your KE goes up. And what Miller-Modigliani showed is as you increase your weight in debt, the increase in KE exactly offsets that. And so your WACC doesn't change. Doesn't matter how much debt you have, as you increase your debt, your KE goes up exactly the amount that causes your WACC not to change, right? Yeah, is that coming back to you at all from your 3013, right? So they said it doesn't matter how much debt you have, doesn't matter how much equity you have, the cost of capital of the firm is exactly the same before taxes. Does it change after taxes? Well, you take that times 1 minus your tax rate. Why do you do that? Because interest expense is tax deductible, dividends are not. So interest is tax deductible. So someone needs to mute themselves. I can't get to it. So interest expense is tax deductible. If it's tax deductible, that means when you borrow money, the US taxpayer covers some of your costs of capital. So then they say, well, in that case, you should go 99.999% debt and 0.00001% equity and get all that tax shield. But what's wrong with that? Well, you borrow too much money, your bankruptcy costs go up. You start becoming a dangerous company. All your best employees leave you. Your bondholders demand, and if you go 100% debt, your bondholders are essentially stockholders, right? So they're just going to charge you your cost of equity anyway. So at some point you borrow so much money that your WACC starts going back up again. All right. So the key with Miller-Modigliani that you absolutely need to know, I'm going to have to tie it back to insurance companies because they're different. But the key to Miller-Modigliani is as you increase your debt, your cost of capital comes down, not because debt is cheaper, but entirely because of the tax shield of debt. The only reason your cost of capital falls is because some of your debt, your costs are covered by taxes. But at some point, you borrow too much money and your WACC starts rising again because of that bankruptcy cost. And so you'll see charts like this. Y'all remember seeing a chart like this in 3013? It's familiar to anybody? How do you get a chart like this? It's pretty easy to do. You just type in optimal capital structure. I'm going to do Wikipedia because I'm absolutely convinced Miller-Modigliani are going to be in there. There it is right there. So, or they do Modigliani Miller. That is completely wrong. I could never, it's always Miller-Modigliani. I don't know why they got that backwards. If I click on that, it's probably going to have one of those graphs in it. Yeah, there's one of those graphs right there. You'll see those charts all the time. You'll see these formulas. So you should have had that. The value of the firm levered, the value of the firm unlevered. What is this? The value of the firm levered is the value of the firm without debt plus what? What do you think that is? The tax shield of debt. Yeah. And it's this whole thing. It's really your marginal tax rate times it's amazing how simple it is. The value of firm with debt is the value of the firm unlevered plus its tax rate times the amount of debt it borrows. So if Google has zero debt and their tax rate's 30%, if they borrow $1 billion, the firm value goes up $300 million just like that. That's how simple the formula is. That seems amazing, isn't it? But that's the formula. It really is that simple. And it's hard to imagine something that simple, but this ignores bankruptcy costs. So you have to bring the bankruptcy costs in, but if you ignore, so there it is with taxes, further reading, there's all kinds. So this, don't graduate without knowing this theory because it is one of those really, really critically important theories. You can also just click on images and you'll see all these charts. Now, what you'll notice is two types of charts, basically. There's a few more. Sometimes you'll see a chart where the lines are going up. Sometimes you'll see a chart where the lines going down. How do you know which chart that you have? If the lines are going up, the y-axis is the value of the firm. If the lines are going down, the y-axis is the cost of capital. What's the maximum value of the firm? You probably had a multiple choice question like this on your 3013 class. The maximum value of the firm is when cost of capital is what? Maximum firm value is minimum WACC, minimum cost of capital. Does that ring a bell? When did y'all have 3013? Could have been too long ago, right? None of y'all had 3013 with me, so you're off the hook. But you should have had this, right? This is pretty critical stuff. All right, so the maximum value of the firm is at minimal WACC. WACC comes down entirely because of taxes. Has nothing to do with the fact that debt is less expensive than equity. It has entirely to do, so if we did this without taxes, if we did this without taxes and bankruptcy, what would this line be? WACC, it would just be a straight line. Without taxes, this just be a straight line. With taxes, the WACC comes down because the taxpayers are covering some of your debt. But at some point, your cost of debt starts rising because people are worried about bankruptcy and it starts going back up. The maximum value of the firm is at where WACC is minimized. Right? So what is the x-axis? The x-axis is how much debt the firm has. So you start off with no debt. This is the value of the unlevered firm. You add debt. Here, you start off with no debt, you add debt, your WACC comes down here, the value of the firm goes up. I've seen this chart before where they talk about, here's the value of the firm. As you borrow more money, this line should not come back down. Here it is when you bring in the bankruptcy. So at some point, the bankruptcy costs are going to start adding up and you want to maximize those two. Now, is this theoretical or is this actually practical? I've always thought of it as more theoretical. If you go to USAA and talk to their debt department, they know this theory, they talk about it, but they don't actually go out and find the optimal level. But if you listen to Dr. Damodaran, he does this. He has videos where he doesn't just talk about this, he actually goes out and finds the optimal capital structure for companies. And he shows you how he calculates it. So he did Disney and one other firm. He showed that Disney should have more debt, and he showed that this other company should have had less debt. And he calculated it precisely. He said Disney should have, I don't know what the number was, but Disney should have 46.2387% debt. I mean, it's like very, very precise. And this firm needs to reduce down to here. So there are people, he's the only one I know that's that precise, but there are people who actually do these calculations. I doubt you did the calculations in your class. But it gets a little tough to figure out the bankruptcy cost. He does in a way, I think, and I'm doing this on film, so this is not good, but he does in a way I think is too simplistic. He uses the time interest earned. Do you remember that formula? Your earnings before taxes and interest and taxes divided by your interest expense. Do you remember that formula, times interest earned? He uses times interest earned to figure out if a firm has too much debt or too little debt. He uses that to calculate the bankruptcy costs. I think that to me seems too simplistic, but I don't know the data he has backing that up. But that's the only thing he uses is times interest earned and the tax rate, obviously, and he puts those two together and he gets precisely the level of debt. But these graphs all look really, really similar, at least the ones, you're either going down or going up. Some of them I think are a little weird. I'm not exactly sure what they're trying to graph there. So which one is this? What's on my axis over here? Cost of capital. And you can tell because it's coming down, all right? And so this is the optimal level of the firm. This is debt to equity over here. Here's the cost of equity, the cost of debt. and they have the bankruptcy costs somewhere in there. I don't know exactly how they're getting the numbers here. I would put the bankruptcy costs as part of the cost of debt, but they don't do that here. But you do see, and to me, this seems a little wild. I would think the bond market would start charging them more a lot earlier than here. So that, I'm not sure how accurate this is, but these are kind of things that you see. So that's the way you're supposed to think about capital structure, all right? That's the typical company. And you always want to be thinking Miller-Modigliani as your framework because that's the most important theory out there. But when you come to a bank or an insurance company, it gets a little, there's some differences here. So you have to think about it a little bit different, but I do want you to go back and remember this theory because you don't want to graduate without knowing it. So cost of debt's less than cost of equity. It implies more debt would reduce WACC, but beta is going to raise your cost of equity. So before taxes, they offset each other, no impact. Now, the funny story they tell about this is, I don't remember which one, Miller or Modigliani was presenting this theory at a conference. This is the before tax one, telling people debt doesn't matter, paying dividends doesn't matter, issuing stock doesn't matter, none of it has any value, any importance to the value of the firm. In the middle of his presentation, someone came in and said AT&T changed their dividend policy and the whole room emptied. So someone came in and said something about capital structure. He's just told them it doesn't matter. They all emptied the room because to them it did matter. So there's obviously something else going on, and they talk about this as well. There is a signaling effect as well to capital structure. So firms tend to prefer certain things over others, and so there's more going on here. So they had their phase one, their phase two. They had to keep adjusting this because the markets weren't reacting the way their theory said. And so if the markets aren't reacting the way the theory says, either there's something missing from the theory or the markets are wrong. And most finance professors never assume the market's wrong. So they try to adjust their theory to the market. And so that's what they do, bring more things in. So you got to bring in taxes, you got to bring in bankruptcy, and then you got to bring in the signaling effect. And that's kind of the politics of being a manager of a firm. So after tax, you get the tax shield. You also get bankruptcy costs of firm. Boy, if you don't know this, memorize it tonight and know it forever. Firm value is maximized where cost of capital is minimized. Now, Valero made this argument for them. Valero was arguing that corner stores were more valuable than the market was giving them credit. And their argument was the fact that Cornerstone, you remember Corner Store used to be part of Valero. The fact that it was part of Valero, they felt that the market was using a wrong discount rate for corner stores, that the discount rate was too high. And so they felt like if they split corner stores off, they would get more value from it because they get a lower discount rate. So there are firms that make major strategic decisions entirely based on WACC. And I think that's true of GE. I think GE's cost of capital is higher because GE is so complicated, you really can't get a good discount rate for it. And that's why every time GE announces they're going to spin something off, its value goes up because they're becoming a less complicated firm. Now, Berkshire Hathaway's, a complicated firm. I don't know if Berkshire Hathaway's value would go up. They started spinning things off because it's kind of a different kind of company. But conglomerates are traditionally thought of as firms that are undervalued because of their complexity. I think Disney may be getting to that point where there's so many pieces you really don't know what discount rate to use. All right, so at some point, cost of debt increases because of the risk of bankruptcy. The WACC starts going up again. Does this apply to insurance companies? It does, but there's a lot of other factors that you have to keep in mind. And the biggest factor is the regulatory side. So financial firms, they don't think about optimal levels of capital. They think about capital as net worth, first of all, and they think about how much capital we need to cover our risk. So it's a little bit different thing. So if you're going to interview with a bank, I don't know if any of y'all have interviewed with a bank, there's a few terms you would want to look up. The Basel Accord, definitely look that up. And I would do Wikipedia. I like Wikipedia. I mean, it's possible, right, that someone went in and put a lot of bogus stuff into it, but probably not. The Basel Accord. So if you interview with the bank, I would read Basel 1, 2, 3. This is real critical for banks. How much capital do you need? Have y'all walked into a bank and they show you their tier 1 capital? It's 11%, 12%. You walk into a Frost bank, our tier 1 capital is 12%. What does that mean? If you're a finance person, you're going to interview with Frost Bank, you better know what their tier 1 capital is, and you better know what it means. How do they calculate it? But you can easily get it here. I think the word tier might even be in here. Tier 1, tier 2, they're all related. Look at what Wikipedia does for you over here. A lot of stuff. So on banks, you talk about capital. Capital is the amount of money you have there that protects you in case of risk so you don't go insolvent. Have y'all heard of stress test? That sound familiar? Bank stress test? What the stress tests mean is, do the banks have enough net worth to handle this recession or this market event? So for banks, capital is not just the optimal level, it's also how much do you need to cover your risk. So it's a different, Walmart doesn't think that way, Facebook doesn't think that way, but insurance companies and banks think that way. For insurance companies, we talk about risk-based capital. RBC. But it's a very similar concept to the tier 1 capital that you see. We're going to talk about RBC later when we get into Allstate and their financials. Risk-based capital is how much net worth you need to cover the risk that you're taking. We're going to get into risk-based capital and look at the formula, but here's the NAIC site. You could have written your paper too on the risk-based capital formula. It's a lot of moving parts to it that you can certainly read about, and there's plenty of articles about it that you could read about, including how do you get catastrophe risk into this risk-based capital, which is the hardest thing they've had to deal with in this formula. So when we're dealing with financial firms, there's the regulators and there's the rating agencies. So capital for them is how much net worth do we need, so the regulators stay off of our back, and we get the credit rating that we want for the rating agencies. So banks, they have tier 1 rating, tier 1 capital. And for banks, it really is how much risk are we taking in our investment portfolio, in our loan portfolio. And they're looking at where the risk is coming from. And they're essentially what they call risk-weighted assets. They essentially take all the assets from the bank and they apply a risk factor to it. So treasuries might be 0%, auto loans might be whatever. And they take that and they say, okay, here's how much capital you need. They compare it to your actual capital. And it needs to be 13% of their risk-weighted assets or whatever. So it's a fairly simple formula, but you can tell from here that there's a lot going on here. There's more than one, obviously if there's tier 1, there's also tier 2. If you're doing an analysis, I don't know if any of you are in a capstone class where you need to do analysis of banks. A good way to do analysis of banks is go to the Bloomberg machines or go to Capital IQ and bring in their tier 1 capital. Higher is better. So if you're trying to figure out, it'd be a really good thing to say, hey, Frost Banks, and I don't know if we can get Frost Bank. Did they give it to us? Tier 1 for Frost over time. There it is. They don't give you the ratio. You want the ratio. You probably have to calculate the ratio yourself, I guess. Or I don't know. Yeah, I'm not sure exactly what they're giving you there. That's their capital. You want their tier 1 capital. So, but if you walk into their lobby, it's going to be sitting there on the screen. If you're interviewing Frost, it'd be nice to know if they're 13% where JP Morgan's 12%. I mean, that'd be good, right? They're much better. It'd be nice to know that going into the interview that they have a really strong capital basis. Insurance companies, risk-based capital, You probably won't know that. I'll show you how you can figure that out. We're going to calculate that for Allstate. You can see the number. It's not as well known for insurance companies. You're probably going to be more focused on their credit ratings, as you probably would for JP Morgan or Frost Bank as well. What are the credit ratings? But the credit ratings are going to be very closely tied to risk-based capital. So what do we mean by capital? For most firms, when we say optimal capital structure, we're talking about debt versus equity. When banks and insurance companies use the word capital, they always talk about net worth. And why is that? Because most insurance companies and banks don't borrow a lot of money. Remember Berkshire Hathaway, how does he borrow money? He borrows it from his policyholders, right? So they don't think of debt in those terms, and the debt they do have is really their customers. So capital is their net worth. So financial services, when you hear the word capital, I know actuaries, every time I've heard an actuary in an insurance company use the word capital, they're talking about the net worth of the firm. They're not talking about debt and equity. Do we have enough capital for our risk? Notice there's no comment about do we have enough capital to optimize the value of this firm. So probably what would happen at an Allstate insurance company is thinking about capital in terms of the capital we need for our risk. And Allstate's holding company is probably thinking about capital in terms of debt and equity and optimizing the value of the firm. They're probably both there, but the actuaries and the finance people in the insurance company have a very different perspective on that term. And then you have the accountants. The accountants think capital is on the asset side. We had this big debate at UTSA. I was on a project team called Capital Management, and we worked for 6 months. And at the end of 6 months, we still had no clue what the word capital meant. We couldn't agree on that term. The accountants were saying capital. We have capital assets. We have buildings. We have trucks. We have computers. We're like, no, capital is you borrow money, you get stock to go buy those capital assets. But the capital assets are the assets, but the capital is the money we got to buy the asset. We could never agree on that term. But if you're an actuary, just know the word capital means the net worth of the firm, and it's talking about the cushion for risk. All right. So when we're talking about pricing, then this return on capital, how else could you write return on capital for an insurance company? Return on capital equals return on equity. Why is that? Because capital for an insurance company is the equity of the firm. We don't talk about the liabilities or the debt. Everybody see that? Trying to keep you out of trouble in an interview. All right. We use the word capital very different in insurance and banking than the rest of the world does. So just be aware that when they talk about return on capital, they mean return on equity. All right. So the premium we're going to be doing is a pure premium. That's where we're going to focus in on frequency and severity and the time value. Expenses, the present value expenses, but two expenses, loss adjustment expenses and underwriting expenses. The loss adjustment expenses are very closely tied to the pure premium. And then the profit is going to be based on, I'm going to keep it really simple. We're going to use a very simple formula. We're not going to use risk-based capital. We're going to use a surplus ratio, but they're going to be closely tied to the risk the firm has, and we'll see that. The profit is going to be the required return on equity times the required capital, which is required net worth, which is also equity. And what we're going to see here, which is really, really critical, is the more risk the firm has, the more capital it needs. And the more risk the firm has, the higher the return that it needs. So you talk about optimal level for a firm. If they're riskier, they need a higher return and have to hold more capital, which means a riskier firm is going to have to earn a lot more money. Both the required return and the required equity are both going up at the same time. So risk is extremely expensive for insurance companies. I'm going to show you how UTSA handled this. Our CEO had a very interesting way to do it, where he said, if you're going to riskier things and require more capital, I'm going to penalize you for it. So he was actually penalizing the business units for requiring him to hold more capital, which made perfect sense. That's the way you'd want to do it. All right. So we're going to get into this from number crunching here. I'll let you out a little early because I don't want to start the number crunching. So definitely bring your calculator next class. We'll definitely be getting into this. All right, that's it for tonight. Any questions, anything?